Welcome to the Standard Deviations podcast, presented by Orion Advisor Solutions and hosted by Dr. Daniel Crosby, Orion's Chief Behavioral Officer and New York Times best-selling author. Each week, Dr. Crosby interviews a fascinating new guest on a range of compelling topics, from literature to psychology to financial wellness. To learn more about Dr. Crosby's behavioral finance work at Orion, visit www.orion.com.
Hello and welcome to the Standard Deviations podcast. I am your host, Dr. Daniel Crosby. I am joined today by one of the kings of the financial podcasting world, Michael Batnick. Welcome to the show, sir.
Thank you so much for having me.
Incredible to have you here. So a lot of podcasts start out by tell us how you got where you are. And normally I really hate that question, but with you, I'm going to ask it because it's actually interesting. So the story of how you landed at Ritholtz Wealth Management is worth retelling for anyone who's unfamiliar with it. So how'd you get to where you are today?
Okay, so I've told this story several dozen times. So I'm going to give the abridged version.
Sure.
And anything that you want me to expand upon, you just pull on that thread.
I'll do it.
Okay. All right. So I was a goof off growing up. I was much more interested in sports than school. Not that I was some great athlete, but I didn't care about grades. I was never motivated by grades. I didn't take school seriously. And I paid the price for that. I was dismissed twice from the same college, not because I did anything so bad. I just didn't go to school. So, you can only get a 0.8 so many times before they're like, yeah, you probably don't belong here. So then I graduated during the GFC, and I realized quickly, I know it sounds so ridiculous for me to say these words, but truly I didn't think about my future. But I had that realization oh, this is why people actually tried in school for their future, for today. That just completely was lost on me. And so I found myself at an insurance company, and I got sort of lucky that it was one of the biggest agencies in the country because it was on Fifth Avenue in Manhattan. And I got there and people are wearing suits and they look good and they're making money. And I sort of thought no harm, no foul. Yeah, I messed up, but I landed on my feet, no big deal. And anybody who started out in the insurance industry like I did realizes very quickly that it's difficult. It's most people don't make it because essentially what they're trying to have you do is sell things that people don't necessarily need to people that you don't know, which is tough. I'm not a natural salesman. And when I figured out what the gig was all about, was selling whole life insurance to everybody as a solution to everything, it was a pretty disappointing discovery when I finally smelled the roses. Because again, I didn't know anything, right? So I called myself a fiduciary because that's what I heard people calling themselves. I didn't know anything. And so the only reason why, by the way, I'm already rambling. I said I was going to keep this quickly. The only reason why I stayed there as long as I did was because, dude, it was 2008. Where was I going, right? What was my resume? Kicked out of college twice? I didn't know anything. So I only stayed there as long as I did, which I don't know, maybe 18 months, but it's because I had nowhere else to go. And the only reason why I was able to leave and sort of stay afloat was I lived with my parents. And when I came home from college, I was a waiter for probably 2 years, I guess, full time. So I was able to save up a decent amount of money. So that helped me stay afloat while I tried to find whatever was next. And I remember I met somebody who I told them I wanted to be involved in the markets. And they're like, oh, just go get a CFA and get a job at a hedge fund. And I was like, oh, cool. Okay, I'll do that. So I started studying for the CFA. And this was early 2009, I guess. And I found Twitter and StockTwits and found the community there, and I was a complete outsider because, again, I didn't know anything. I had no experience. So I was studying at the library. I was basically cramming, making up for lost time, reading books, watching the stock market, just trying to learn as much as I could because, again, I knew nothing. And it wasn't going well for me in terms of reaching out to people, finding a job. I'm not the best people person. I don't sell myself well. I didn't have the chutzpah to just knock on doors. That's not in my personality. I wish it was. It's just not who I am. And so I was out of options. My dad was a dentist. My mother was a secretary. I don't have any people in my life that were in the financial services industry. I don't have a wide natural network. I was about ready to pack it up. I was trying to find a job for like a year, just sending resumes everywhere. I knew that wasn't going to work. I didn't know what else to do. And so I'm thinking like, all right, I guess this just is not in the cards. Do I go get a job at Verizon or Starbucks, or just, I just did it because I was running out of money. I didn't know what to do. And then luckily I met Josh Brown at the train station one night. We grew up in the same town. I had been watching Josh on CNBC. I had been reading his blog, and he was kind of like my North Star, because what he was writing about, his experiences in the financial services industry, I saw the exact same incentives at the insurance company. Now, I wouldn't say that the behavior was maybe as dirty, for lack of a better word. I guess in some cases it was, but I saw how incentives make the world go. And so I met Josh at the train station. I basically tackled him. And I saw that a few months later, him and Barry were hiring. And I threw my hat in the ring, and the rest is history.
So here's the follow-on question from that. Are there lessons to learn from this? So is this all just dumb luck? Is this chutzpah? Is it initiative? Is it a mix of both? How do you attribute? I mean, because you've had massive success since that time. How do you make attribution for that?
All right. So the meeting, Josh, was pure dumb luck. And because so many things had to go into that. And I've spoken about this before. I'll just keep it real quick. Like, I was at a Knicks playoff game, and I left in the third quarter for various reasons. And I would never, ever, ever have left. But something triggered me on that. And it wasn't the Knicks. Something happened on that night for me to leave early. It was like 10:45 at night on a Friday that Josh just happened to be in the city. So all of that had to go right. All of that was pure dumb luck. Matter of fact, my phone died as we were pulling into the train station. I was reading something that Josh was tweeting about. And if my phone didn't die, I probably would have had my face in my phone and walked right past him. So many things had to go right for me to meet him. So that part of it was obviously very serendipitous, completely out of my hands. If that did not occur, my life would look very, very different today. Now, that's the luck part of it. The part of it where I can take a little bit of credit is that I was hyper prepared for that meeting, for that chance encounter, because when Josh brought me in to interview, I was prepared. I could talk the language, and I didn't I wasn't trying to blow him away with my knowledge. I was very, very upfront that, listen, I'm just asking for a chance. Mm-hmm. Like, I wasn't trying to blow him away with my charts or any nonsense like that. You know what I mean? I wasn't faking it. I just said, I am obsessed with the market, and I will do whatever you need me to do to get this job. So being prepared, spending all those hours in the library, just learning and familiarizing myself and showing enthusiasm, that was the part that I can take a little bit of credit for.
Well, it's really a great metaphor, I think, for a lot of life, right? So a lot of it's so lucky, the phone dying, running into him on a Friday night late, all this absolute luck. But the preparation piece, if you had not been watching him, if you had not had your nose in a book, if you had not been prepared, if you had not been candid, all these things. And then, of course, once the door opens for you, you've, of course, run through it and done incredible things with that opportunity. Your stuff is so widely read and widely disseminated because it's so good. So it's all you can do is prepare for those moments when everything clicks in place and the universe puts a Josh Brown in front of you. Early on in my FinTwit days, I met Phil Perlman. So he was one of the people that I first met on here, Dr. Phil. And so he invited me to Josh's book launch. So it was the launch of Backstage Wall Street. And I just happened to be in Manhattan for the launch of Backstage Wall Street. I didn't do much with that opportunity, though. I sat by the punch bowl and I cowered in a corner for like 15 minutes until anxiety overwhelmed me and I left. But it's all worked out still too.
So, you know what's weird about? I don't think this is weird about me. I think that this is probably. I'm sure I'm not the only one who feels this way. I have internal confidence. Like, I believe in myself. I believe that if somebody just gave me an opportunity, that I could do good things. Mm-hmm. But I wasn't outwardly confident. You know what I mean? I was very self-conscious outwardly. Yeah. So I don't know how to square that circle, but that part of it was tough.
Yeah. But you took the shot. You're where you are today because you took your shot. Now you have one of my favorite blogs on earth. You're an accessible writer. And I loved one of your recent pieces. One of the things that I love is that you sort of challenge convention. You challenge these overarching narratives. And in your recent piece, The Generational Wealth Gap, you challenge sort of the meta narrative that's going around right now that our parents had it easy. That, yeah, sure, back in the day when our parents were coming up, you could buy a house for $10. It was 1 month's salary to buy a house, and then you rode off into the sunset. You say in that piece that you're not buying the common narrative that our parents had it much easier than we do now. Why not?
Yeah, I don't buy that at all. Life isn't easy for everyone, and I think it's easy to complain. And by the way, some people in my generation have gotten the short end of the straw, so I don't want to be completely insensitive. I do think that there is a lot of people that got left behind, that got a raw deal, but that doesn't mean that our parents had it easy. So here's what I mean, and this was really sparked by an email that came into us, which reframed how I thought about this, because I don't know that I necessarily bought the narrative, but this email made me view it through another light. So, okay, our parents came into the workforce in the 70s, not arguably, the worst decade since the 1930s for the stock market, for the economy, no growth with inflation, just an absolutely brutal time to be a young person entering the workforce. Okay, so they did that. Then they got the crash in 1987. And okay, that was an event that, I guess we could sort of look past that now. But then coming into their peak earning years, the dot-com bubble bursts. Mm-hmm. And then, okay, it took 6 years to get back to even, 7 years. And just as they're on the back end of their career, getting ready for retirement, in some cases retiring, depending on how old you were, a 55% stock market crash. So in 2008, don't you think that our parents were thinking, this is not fair? I came into my career in the worst economy since the 1930s. My peak earning years my peak earning years were bookended by two crashes. This another crash right as I'm getting ready to retire. What am I going to do? I don't have time to refill those assets, to refill that bucket. What am I going to do? Now, 13 years later, we know how it turned out.
Yeah.
But that was not an easy path. And I'm only framing this through the lens of the stock market, notwithstanding anything else that could get in the way. But it's easy to look back in hindsight and say, oh, they were able to buy stocks at a 10 PE, and they were able to have bonds with the rates at their back, bonds at 8%. But what about the fact that, yeah, their first house was $100,000, but the mortgage was 12%, right? And what about the fact that their first house was 1,100 square feet with one bathroom? So I'm not saying that we have it easy. I just don't think that they had it any easier than we do. And I just don't buy their narrative, even though, again, we've got some things that really stink, like student loan debt. I feel for people that are struggling with that. But I just don't buy the overarching narrative that our parents left us holding some sort of bag. I just don't buy it.
Yeah, it's really an incredible thing to consider that no matter when you're born, on average, you're going to get a bear market about every 7 years, like a face ripper every 7 years. You're going to get a correction every single year. And then the other various metrics that you talk about will be more or less in or out of your favor. There's really no, if you think that you're going to work for 40 or 50 years, there's no smooth 40 or 50 year period. When my parents, when I was coming up, my dad was maniacal about paying off our house. We didn't go on a vacation ever. We ate corned beef out of a can every night, beanie weenies. Just the most disgusting food. And then when I talked to him as an adult, I'm like, why were you so crazy about this? And he's like, my interest rate was 13% on that house. I was dying. And yes, rates elsewhere, yields elsewhere were better, but still, there's no easy 50-year path through the world of finance. So I wouldn't
change places with my parents, to go back to then. And then also, I think the big thing is people talk about real estate. My parents bought a house for $100,000. It's now worth $500,000. I'll never have that opportunity again. Okay, granted, let's say that our parents might have been able to, I don't even want to say make a killing, because it's just not true. If you go from 100 to 500, what are we talking about? 4%, which is great. Again, but you're not adjusting for anything. You're not adjusting for space in the house, for how much the mortgage payments were on an inflation-adjusted, interest rate-adjusted basis, how how much they paid in taxes and renovation. Like none of that gets factored into the mental calculation. People think, okay, 100 to 500, that's this percent return. No, it's not. It's just not. You're not doing all of the math to really adjust for the actual expenses of that house.
Yeah, we talked about that actually in the last episode, this money illusion, right? People think about it strictly in nominal terms. Look, grandma got a 5-bagger on her house, right? But yeah, you didn't factor in all the mishaps and the property taxes and everything that went into it. Real estate isn't quite as good as folks think it is typically. Another great piece, Michael, that you wrote recently was about yield shortage. Title of it was Yield Shortage. And you showed that the yield on a 50-50 stock bond portfolio has never been lower than it is today. That's a lot of risk to not even keep up with historical inflation numbers. It's now sub 2% on a 50-50 portfolio. What are investors supposed to do? And how do we keep people from just chasing yield and sort of moving up the risk spectrum when yields are this anemic?
There's no yield to chase, Daniel. I mean, there is, I guess, but I was on the phone with the trading desk today, one of our custodians, and I was just asking about something, and they said that they were pricing out a 2-year note for Barclays, which is single A. It's reputable. It's a good credit rating, solid company. A 2-year note, 20 basis points. So if you want any sort of yield, you have to go way past that, way out on the risk spectrum. I know credit spreads move around all the time, but they're at the tightest level I think maybe ever. Like, so even for junk bonds, what are you getting? 4.5% maybe. Yeah. So from that, looking at it through that lens, it's tough. I would just say that we've had these conversations. What do I do with bonds? What do I do about low rates? For literally 5 years at this point, maybe longer. Mm-hmm. And luckily, and I'm not saying that this is going to continue, but luckily, stocks have more than made up for it, right? Whatever you're not getting on bonds has been more than made up for with stocks. Now, that doesn't help us going forward, right? Going forward, Houston, we still have a problem because bond yields are what they are. You can't manufacture rates where we're not Jerome Powell. What are we going to do? There's something we can do. And then on the stock side, I get it. Like valuations are, quote, stretched by historical standards, even though I have a bit of a problem with that. I get it. So I'm not incredibly bullish on a traditional stock bond portfolio over the next, whatever, call it 10 years. But what's the alternative? Right? Like, so I know it's not fun to say to people, deal with it, but what are you going to do? Like you only have so many choices. And I know save more is not some people don't have the ability. I know that's not fun. Nobody wants to hear that. But you have a few choices. I mean, save more or don't save more. Take more risk or don't take more risk. It's all about trade-offs. And so I think that if you are going further out on the risk spectrum, then maybe you'll get reward. Maybe you'll just get the risk. I mean, I don't know. But I think I get it. I get that this is like the big question of the day.
Yeah. Well, you really lay it out well. There's only a few levers you can pull, right? There's more saving and there's more risk. It seems like to me a good time to reinvest in yourself. You're the engine of your wealth. Like go learn a new skill, get a side hustle, whatever, start a small business. It seems like a good time to invest in yourself with stocks stretched and bonds looking pretty crummy because there's really only so many levers you can pull at the end of the day.
And as market people, it's our job to obsess over this, and I do. But for the average person, go live your life, right? Yeah. Like, don't spend so much time thinking about how you could eke out extra returns. I mean, if this is like your passion, your hobby, that's one thing. But just for the average person, you can't control it. Don't try like you can. Just focus on to your point, bettering yourself, taking courses, learning new skills, things like that could actually move the needle.
Yeah, so you actually set this up. So I made we'll see if this was a mistake or not. I put it to Twitter to ask you questions. And of course, got the usual mix of great stuff and snark and lunacy and everything you get when you put it to Twitter. But one question that was the most favorited of all was from Twitter user Wookie Index. I'm going to laugh when I read these names. Wookie Index is a listener to your show, and sort of apropos of all this, has heard you talk about diversifying into other asset classes, going into less traditional spaces to look for yield and investment alternatives, and wants to know, is there such a thing as too much diversification?
That's a good question. Okay, so I'm talking for me personally. My entire livelihood is in the stock market. My entire 401k is in the stock market. My business is levered to the stock market. So my future, I'm going to go where the stock market takes me, for better or for worse. Mm-hmm. So I am doing everything I can to diversify my investments away from the stock market. That being said, I can't diversify enough away from the stock market. You know what I mean? Like, for whatever happens, I'm going where the stock market takes me. So I have invested in art through Masterworks and real estate through Fundrise. I've invested in crypto, and I've done some private investments. And yeah, so I'm doing all sorts of things, but there's a few caveats here. A lot of this is for my own entertainment. And I really and truly mean that. I'm not looking to get hosed, obviously, but whether or not I beat the S&P 500 is sort of irrelevant. I'm enjoying it. I'm learning. I'm exploring. And again, at the end of the day, it's not going to move my personal needle. Now, would I encourage somebody, a regular person, to follow in these footsteps because they want to diversify away from the S&P 500? I don't know. That's not for me to say. I would just say, be careful, know what you're getting yourself into, understand the risk characteristics, the liquidity characteristics and constraints. So for me, this feels like the right answer. I don't know that it's the right answer for everyone. And am I too diversified? I'm having fun. Again, if I wasn't in the field, if I wasn't, I wouldn't be doing this. There's no way I would be doing this.
Yeah, you make a good point, though. I think some of us in finance have to work a little extra hard to get outside of that, because all of our chips are stacked squarely in one space. We both have podcasts that are about markets. We have jobs that are in markets. We're invested in markets. I have a buddy, my best friend is a realtor, and he was talking about getting some rental properties for investments. And I was like, think it through. Kind of, if your whole livelihood is based on real estate in your local market, now you want to get rental properties in your local market. I think it's a good way to think about this. You brought up crypto, you brought up NFTs.
By the way, one more thing, just one more thing that I didn't mention. And I'm still contributing to a taxable account.
Sure.
Like a significant amount of money. Like I'm all in on the stock market. I want to eat my own cooking and do what I tell people to do, which is to buy stocks and to hold for the long term, and to sort of let compounding work and understand that obviously stocks are risky, and I'm perfectly comfortable getting cut in half. That's part of the deal that I signed up for. So I'm still doing that on top of my 401k. So I really and truly, I'm all in on the long-term productivity of American companies and global companies. So I just wanted to put that out there.
No, as am I. So Twitter user Greg Gunther asked about your NFT purchases. You talked about crypto. I saw you released a piece right before we went live today. I haven't been able to read it, but I believe this landed you and your wife a mention in the New York Times. And tell us about tell us about, first of all, your personal experience with NFTs, and then how you think about that part of the market, be it, card collecting, NFTs, art, other crypto.
Yeah. So I think that like certain segments of the collector market, specifically art, I don't want to say it's a play on, because this sounds disgusting, but it's a way to, I don't know how to say this without sounding like a jerk. It's a way to benefit from wealth inequality, which we talk about a lot. I don't think anybody's for wealth inequality, but the thing that I'm trying to say is that rich people have too much money. And so that's why I'm bullish on the long-term aspects of the art market, like physical art, actual real art. As far as the NFT stuff, this is something that I got involved in really for fun, to try and learn more. Obviously, this is a nascent space ecosystem, as the participants would say. No idea what the future holds for NFTs, for people, like for artists and for musicians. But I think that I'm super intrigued. I'm not an early adopter, and these things have been around for a while, but it's unlike me that I would like jump into something like this. But I think because there was a sports aspect of it, and the NBA is something I'm passionate about. This caught my eye. And so it's funny. So the piece that I just put out, I published my first piece of Top Shot, like literally at the top, at the very, very top. And it was bananas at the time. Like I knew that it was unsustainable. I didn't know that was the top, but I knew that like it couldn't continue because I still have the top sale for a Donovan Mitchell moment. I bought it for $9.99. I sold it for $21.99. That's still the top. So I bought some at the top. I sold some at the top. And it looks like I'm going to walk away with like a 10 to 15% haircut, which is no big deal, right? So I made the case that like, even though it feels like the bubble burst, I think it's kind of not fair to call this a bubble because it went from 0 to 2 billion down to 1 billion. It still went from 0 to $1 billion.
Sure.
Right? Like that's pretty impressive. In a bubble, everybody loses all their money when a bubble bursts. That's not the case here, at least not yet. So I don't have any strong opinions on like sneakers or socks or digital real estate. It's so early. And I think that all of this is a result of crypto because as you know too well, when you are at a poker table or a blackjack table, the chips don't feel like real money, right? It feels like house money. I love playing blackjack. I would never put down $100 bill on a single hand.
Yeah.
But I'm okay putting down $100 chip. Same thing with crypto. It doesn't feel real. And if you've got $10 million in Ethereum, well, what's the difference if you're spending 70 grand on a Zion moment? Like it doesn't feel real. So I think this is a derivative of that. And I'm excited to see where it's going to go. I think that there's going to be a lot of money made, a lot of money lost, but I have no predictions on I don't know enough to say who's going to be winners and who's going to be losers.
You know, you make a fascinating point that's been borne out by the research. Dan Ariely actually did research on dishonesty in money and found that the further away you get from physical, tangible cash, the more likely people are to commit crime or fraud. So there are people who would never take $5 from a till, who would take $5 from a bank account, via wire fraud or via, stealing credit card numbers or something like that. There's a degree of separation from that. And I think the reverse is also true with our spending. We know that people overspend with credit cards relative to cash. And I think, we all know about the house money effect too. And so many crypto investors are sitting so far north of their original, their basis in their investment that it feels like funny money. And it's fueling a lot of what's out there.
Yeah, totally. It's funny money on funny money. So I was listening to Patrick O'Shaughnessy's podcast with the guys from the Churning Group. And one of them said that, I don't know if he was talking about specifically about Nifty Gateway, but basically NFTs feel like the biggest thing since like the internet browser. I think he said something like that. So a lot of smart people are all in. I don't understand the mechanics. I'm not like a computer science nerd. I don't really understand how it works. I get some of the ideas. I don't understand how value is derived other than people think it's value. Like I can't explain it. So clearly I don't understand it well enough, but I guess like everybody else, I'm confused and I'm excited and I'm learning. And I think it's fun.
One of the things that I think I've learned from the whole crypto phenomenon is to suspend disbelief. Like when Bitcoin first burst onto the scene, my initial reaction was like, this is nonsense. Like this is digital, digital magic money. This is absolute nonsense. And then the more I've learned, I wouldn't say I'm a crypto enthusiast or very bullish on it personally, but the more I've learned, the more legitimate it's become in my mind. And I think, when you get smart people excited about a phenomenon in markets, I think it's best to have sort of interested ambivalence be your go-to response instead of immediately wanting to camp or decamp into one side or another. I think that's what I've learned from crypto. So a question here from Twitter user Schmains, I'm probably butchering this. He asks about, you have a story about learning to stop actively trading, right? You sort of fancied yourself an active trader early on. You learned your lesson. There's been a massive influx of new investors with the advent of free trading, Robinhood and the like, and the onset of the pandemic. Yeah.
I'm one of them. I'm back.
You're back. Oh, you're back.
Yeah, I'm back.
Tell us your story. So the question is this: is this a net positive or a net negative, right? Like, so on the one hand, people are getting into markets, right? They're getting exposed to the markets. But on the other hand, arguably, they're learning all the wrong lessons. They're learning, the worst lessons possible. So how do you think about this as a net positive or a net negative?
I don't think that you could boil it down to good or bad. It's like asking, is social media good?
Yeah.
Right. There's aspects of it that are phenomenal, and there's aspects of it that are absolutely awful. And I feel the exact same way about Robinhood, about commission-free trading. On the one hand, you have people that are going to learn early on how difficult it is and respect the market, that this is not a game. And then on the other hand, you have people that are going to think it's a game. Oh, this is one big casino, that are never going to unlearn those lessons. So I cannot say it's good or bad. Right? It's just, life's not that clean. There's millions of participants. Some will do well, others will not. Do I think we're better off because of it? It's complicated. I don't really want to say like yes or no. But how just my evolution, and I'm not self-delusional. I don't bull myself. Like, I'm pretty honest about who I am and my limitations. And and that's one part of it. The other part of it is that I kept a journal. I was writing down every single trade I was making and why every single time. And Daniel, I was shorting Amazon in 2011. And I would read that in 2012. And I would see my results, and I would look back at what I was writing, and it just sounded like nonsense. I was cringing reading my own handwriting because it was complete and utter nonsense. And so if I didn't keep a journal, it's very possible that, like most people, I wouldn't have actually known my results, right? Do most people know their returns? Probably not, but I couldn't delude myself because it was my own handwriting. So I credit that, not that I'm some master self-aware person, but it was my own handwriting.
Right. So you make a great point. It's not good or bad inherently. It's only as good or as bad as you make it. And I think that journaling is one way to ensure that you have a good experience. In the Behavioral Investor, I wrote about how poorly people recall their own returns. Like, basically, people have a black hole in their memory for all the bad stuff, and are vividly and keenly aware of their best trades. And, they forget all the bad stuff. They remember all the good stuff and have sort of a misattribution because of that. So I guess the advice then is, like, if you're going to do it in a way where you continue to learn along the way, size your position such that you don't blow up. I saw a TikTok, of course, thing yesterday about some guy who lost everything doing some crazy YOLO options trade. But yeah, size your bets accordingly so that you can learn from the process and take copious notes all along the way, so you can't doubt or misremember why you did what you did.
One more thing is that social media in this sense really helped me. So, and hold on, I'm going to just come back to this in 1 second. As far as Robinhood being good or bad, there's people that had terrible behavior way before free commissions. So I don't think that human behavior all of a sudden changed when commissions went free, although some of the charts would suggest otherwise. But I was on social media in 2009, and I was trying to follow the quote smart people, right? The people with big followings, and the people that were trading and posting their trades. And just by watching this for, I don't know, a week, I quickly realized, oh, this person doesn't know what they're talking about. Or not that I knew that they didn't, not that I could fact check them on the accuracy of what they were saying, but I knew that they were full of you-know-what, right? I just knew that they were either lying or but you can't lie because we have receipts, and you tweeted this 2 days ago. So I quickly learned how difficult trading was. I read Reminiscences of a Stock Operator, and luckily I developed early on a massive respect truly for how difficult it was to beat the market. I didn't have any delusions of grandeur. Early on, I certainly did. I read Market Wizards, and I thought I was going to be the next Paul Tudor Jones. But I disillusioned myself of that fairly quickly just by doing.
Mm-hmm. Yeah, there really is no substitute for doing. Just do it in a measured enough way that you can learn the lessons without setting yourself on fire. So you wrote about that experience in your fantastic book, Big Mistakes. You wrote about your own experience and your own big mistakes. but you also wrote about the big mistakes of other famous investors. Which of those anecdotes sticks with you the most? Which is the one that you still remember and think about today?
Mark Twain. And it's funny because he's the only person in the book who is not an investor in any way, shape, or form, but he was obsessed with investing. I guess you would call him like an angel investor now. He was so susceptible to a good idea, which is funny because he could kill you with his words. Like if there was anybody any historical character I would want to see on Twitter, it would be Mark Twain. And he just kept falling for the same things over and over and over. Now, different ideas, but just he could not help himself, even to his dying day. When he actually did hit it big, he had to have like friends take his money away from him. So he is the one that stays with me just because I don't think you could find a sharper person, right? Just if you've read any of his stuff, just his witticisms, the Twainisms, whatever, are mind-blowingly just hit you over the head. And he fell for it, right? So investing it's so many different things, but just raw intelligence, even emotional intelligence, like it takes so many different disciplines to even be, when I say an average investor, I mean to get the returns of the overall averages. To even do that is supremely difficult.
Yeah, it really is domain specific. That's one of the things that you learn. I think that people who have success in other areas, right, think that will extrapolate to markets. And the skill set you need to be a good investor is not necessarily the skill set you need to write a book or build a business or be successful in myriad other ways. It is a whole new skill set. And it's a skill set that runs contrary 180 degrees to much of human nature. So, the books are full of smart people, Isaac Newton, Mark Twain, who blew themselves up in financial markets by thinking that their genius would generalize, and it just didn't.
Yeah, I just think that the more I write about market history, the more I realize that just the markets are always changing. Like I don't want to be so cynical, but it's almost like there are no lessons to be learned, right? Like anytime you study history, you learn this lesson. Oh, then this happened, and this happened, and this happened. The lesson is don't blow yourself up, right? Yeah. Like don't take too much risk. But the market is so adaptive. It really is like biological in nature that you can't conquer it. You just have to like master yourself, know how much risk you can take. I think like above anything else, that's just the most important thing.
Yeah, it's great advice. One of the things that I do with my kids, this is embarrassing to admit, I'm a big Shark Tank homer. Like I watch Shark Tank with my kids all the time. And then what we do is we say, do you think this business is still around? And so, you're watching a rerun from 2016 or whatever. And you're like, okay, is the business still around? Yay or nay? And I'll tell you 90% of the time, the answer is no. And these are businesses that get funded by billionaires, right? These are businesses that are vetted by 4 or 5 very bright minds, people who've been successful in their own right. And it's hard. Like, it's very, very hard. So last question before we get to the lightning round. You put yourself out there so much, you create so much content. You're, as the kids say, you're extremely online. How do you remain impervious to the slings and arrows of being extremely online, right? Like even when I tweeted out like, hey, what questions do you have for Michael? You get a lot of adoring fans, you get a couple of trolls. Like, how do you balance all the creating you do with sort of the worst of being extremely online?
Yeah, I'm not impervious. I'm actually too pervious. I don't know if that's a word, but I saw your tweet. I didn't look at the replies for the reasons you just mentioned. I don't know that my skin's any thinner than anybody else's, but in my personal life, I don't talk to people I'm not a jerk. Mm-hmm. And some of the things that people say to you, I would never, ever, ever say to somebody else. So sometimes it hurts my feelings, like just be honest, if it feels personal. But if it's so outlandish, I'm able to laugh at it. You know what I mean? Like if the comments are so over the top, I truly am able to like not laugh, but actually crack up at it. Sometimes if it feels personal, I take it personally, and I wish I didn't. But I've struggled with this because I wish I didn't take it personally. But at the same time, if this doesn't get to you, if the personal blows don't get to you, then does that make you like a sociopath? Like, how are you not supposed to feel that? right? So I don't want that either. So I don't love it, but I don't feel bad for myself that I am. I don't even want to say target. It comes with the territory. I'm not like, it's not like I have trolls constantly coming at me. But listen, this is part of the gig. I put myself out there. Some people don't like us. I totally get it. Like I get where it's coming from. So I just try and remind myself of that even if it feels personal, it's usually not. Like, people that are trolling you generally don't have greatest of lives. And I empathize with that. Like, if you're doing good, you're not being a jerk to somebody else. Right. Yeah. So I just try and keep that in the back of my mind. But yeah, I'm not impervious to it. I don't like seeing that. So I deal with it the best I can.
Yeah. I don't know if you're familiar with that, The Man in the Arena poem. It's like, it's corny, but like I reflect back on that, and I think it's the cost of doing anything worthwhile, right? Like if you're going to put yourself out there at all, if you're going to create and put anything out into the world, you're the person in the arena, and there's criticism that comes with it. Some of it warranted, much of it unwarranted. It's just the cost of doing business, I think.
Totally. And it's the price that I am not only willing to pay, I'm thrilled to pay, because again, to circle back to my humble beginnings, I'm so lucky to be where I am. It could have gone so different. So the fact that there's some jerks on the internet from time to time, I mean, bring it on, right? It's certainly a price worth paying.
Yeah. Great perspective. Okay. So you've been incredible. Lightning round here. We're going to do lightning round Animal Spirits edition. So you and your co-host, Ben, have one of the best finance podcasts around, Animal Spirits. Check it out if you haven't yet. So I'm going to ask you a couple of questions, and I want you to say who's better. Is it you or Ben? Okay?
Yep.
Better musician?
It has to be Ben, because I'm not a musician. I see guitars on your wall. I'm not a musician.
better cook?
Me.
Better athlete? All
right. So Ben is definitely the better athlete. He told me, he's so humble. He only told me like a year ago that he was an all-state running back in high school. He played in college, and he played where the Lions used to play. I like Googled and there was a newspaper clip. Ben had like 15 carries for 250 yards and 5 touchdowns. Like, it looked like Madden numbers. And I only just found out about that about a year ago. So definitely Ben. And he's more humble than me too.
So he's, that's not a category. That's not a category. Humility is definitely not a category. But if you want Bo Jackson and Super Tecmo Bowl, Ben is the animal spirit to choose. Exactly. Last question: who's the better investor?
Well, probably Ben, because he is much more patient than I am.
Okay. Well, a very nice shout out to your co-host of a fantastic podcast. Michael, thank you so much for being with us today. Thanks for all the wisdom you shared. If folks want to check out your writing, follow you online, check out your podcast, where can people find you?
Animal Spirits, wherever you listen to podcasts, and michaelbatnick.com is the site.
Okay. All right. Perfect. Thank you so much, Michael.
Yeah. Thank you.
Thanks for tuning in to Standard Deviations. If you can't wait till next week for more behavioral finance insights, visit www.orion.com. All opinions expressed by Dr. Daniel Crosby and podcast guests are solely their own opinions and do not reflect the opinion of or endorsement by Orion and its affiliates, subsidiaries, and employees. This podcast is for informational purposes only and should not be relied upon as a basis for legal, tax, and investment decisions. The opinions are based upon information the participants consider reliable.